Hello guys, Jeff here. Welcome to the Intelligent Investor. In today's video, we're going to talk about preference shares. Preference shares are also known as preferred stock. The main disadvantage of preference shares or preferred stock is that they do not carry any voting rights. Preference shares or preferred stock are a special class of shares that offer prioritized dividend and a higher claim on a company's asset upon liquidation. Now let us look at some of the key features of preference shares. Number 1, priority dividends. Preference shares receive dividends before the ordinary shareholders who hold ordinary stock are paid. The dividend amount is usually fixed, but some preference shares can have dividends that fluctuate. The second feature of preferred shares or preference stocks is limited or no voting rights. Preference shares do not carry voting rights for electing board members or even major decisions such as mergers and acquisitions. They can't vote on important company matters. This is in contrast to common shareholders or ordinary shareholders. Ordinary shareholders have voting rights which make them vote in important company decisions such as mergers and acquisitions or even electing board members. The third feature of preference shares is a higher claim upon liquidation of a company. Preference shares have a higher claim on assets upon the liquidation of a company. If a company goes bankrupt, the preference shareholders or preferred stockholders will be paid first before the ordinary shareholders are paid. This means that preference shareholders are more likely to get some of their investment back than the ordinary shareholders in case of a bankruptcy or in case things go wrong with the company. Now let us look at some of the reasons why investors would choose to buy preference shares over ordinary shares. Number 1, stable income. Investors invest in preference shares to have a stable income. The fixed dividend of preference shares offers investors a more stable income than those of ordinary shareholders. Preference shares are guaranteed to have a certain amount of fixed dividends every single time a dividend is declared. The second reason why investors would prefer to buy preference shares over ordinary shares is the reduced risks. In case of a liquidation, preference shares carry a priority claim on assets of the company. Preference shareholders will be paid first after the creditors are paid. This reduces the risk compared to ordinary shareholders. Now, let us look at things to consider before you invest in preference shares. Number 1, limited upside potential. The fixed dividend payments of preference shares might not keep up with inflation. This limits the potential profits of investors. Also, if a company's business grows, the price of preference shares might not keep up with the price of ordinary shares. The second thing to keep in mind before you buy preference shares is the lack of voting rights. The lack of voting rights means that preference shareholders have no say in the running of the company and in the making of important decisions. Overall, preference shares can be a good investment for investors who are looking for a stable income and reduced risk. However, it is a good idea to consider the limitations of preference shares before you consider investing in them. Okay guys, that is all about preference shares in a nutshell. I hope you have enjoyed this video. In our previous video, we talked about ordinary shares. Go and watch it if you have not watched it. Thank you guys. Kindly subscribe.